I am absolutely delighted to have our finale for the day. Again, this is a project, DC Fintech Week, where we get really the people who are shaping our financial systems, shaping our regulatory systems to participate. And I could think of no better person than Paul Atkins to join us in this final conversation on really shaping the next chapter of American financial innovation. So with that, why don't I welcome the chairman to the stage, and let's get to it. As I was saying backstage, Chairman Atkins is he's an amazing person. When I was just a little junior professor, he actually would say hi to me, and I'd say, "Oh, that's Paul Atkins," and it's always been it's particularly fun to have you here in your new role. But you've worked for the SEC now a couple of times. I mean, this is not your first 3 times. Okay, so when you think about the evolution of the agency and now what it means for you to take the chairmanship at this point in time, obviously what's changed, what's familiar, but is there something about this particular point in time that resonates with any of those past experiences, or maybe diverges a bit?
Well, I think, first it's great to be here and seeing you all here. And Chris, congratulations on attracting a great crowd here. So, it's the SEC, the more things change, the more they stay the same, I guess is a good motto. Like some of the same issues that, we've dealt with back, I was in the chairman's office in the early 90s, came back as a commissioner in the aughts, and then now, of course, come now as chairman. So a lot of the same issues, but with a new twist. So for example, what you all are interested in, the technology side is really front and center. That's job one for us to tackle the whole issue of crypto and digital assets and tokenization and all of that sort of thing. And so we're doing that with relish because it's about time that it happened. I think the agency had 2 iterations. One was ostrich with a head in the sand, hoping maybe this would all go away. And then the second was basically regulation through enforcement. So we're doing neither of those. We want to make sure that we build a strong framework to actually attract people back into the United States who may have fled, but then also to be able to build a framework that makes sense for the future so that innovation can thrive. And I like to say that we're the Securities and Innovation Commission now, so anyway.
Well, in practice, I mean, there are a lot of things that you're sort of facing, both in terms of challenges and opportunities. Maybe can you give us a quick rundown of maybe your top priorities? As I had mentioned, there's a term called tech debt, where in engineering, when you kind of want to build something and you let certain issues lay to the side, they kind of build up and become a bigger challenge to deal with later. Sometimes you can have regulatory debt, when certain kinds of issues are not addressed head on, and even as an enabling factor for innovation. I mean, there are a lot of things out there that you could be focusing on. What are your priorities? What do you think are the things that you think need to really be tackled head on?
Well, I mean, some of it's a little bit like the New York City subway system. It's a lot of deferred maintenance that needs to be done, let's say, but then also new roads to be paved. So in just about every single division of the SEC, there's updating to do, whether it be rules or method of operation, just even internal functioning of the SEC. It really, for example, with a crowd here is interested in innovation and new products. The SEC lacks any sort of project management function at all. But so what I intend to create is a way, like you go to a deli or a bakery and you take a number, the same thing will happen at the SEC, because a lot of products span various divisions of the SEC and also, by the way, different agencies these days. So what we have to do is make sure that we are focused on, trying to move things through the agency, that they don't just stand around and take years to get through, as a lot of they bounce around various internal parts. So there needs to be accountability and a project management function.
So thinking about the Securities Innovation Commission, that innovation in your mind, you have a lot of priorities, things that you have to do. You kind of mentioned enabling innovation in the market, and now you're obviously talking about what innovation means for the agency and in terms of how it operates. Product management was one of the areas that you're thinking about. When you think about embedding innovation into a regulatory agency more generally, what does that actually mean? Maybe you can flesh that out a little bit more in terms of how does a regulatory agency enable innovation?
Well, first of all, by being upfront about it. Here in the past, there was, I'd say, a bit of a disingenuous approach by saying, oh, just come in and talk to us. Here we have a form on the website. It's really easy to fill out. Basically ignoring the fact that people hire a whole phalanx of lawyers and accountants and investment bankers and who knows what else to fill out these registration forms, and you're also filling it out to the government, and there's a section of the criminal code that makes it illegal and a criminal offense to say an untruth to the government. So all of those factors come into play. So we have to be basically embracing new ideas, and if the idea is no good, the marketplace will soon tell the developers of that. But for example, with crypto, we first, I'm very lucky coming back to the SEC. One reason why I agreed to take the job is that two of the commissioners used to be counsel of mine, Hester Peirce, Crypto Mama, and then also Mark Ueda. So here, and then Caroline Crenshaw is also there, so she's a pleasure to work with as well. But the good thing about this is that we're in sync and we can tackle these problems, and I feel safe and justified in being able to be more productive by delegating some things to them. So that's really a great aspect of it. But the crypto aspect is our job one, just because I think we're probably 10 years behind or so here in the United States, just because of the history of what's gone on. But we have to catch up, and so that's part of the embrace of innovation. And so we have a great team that's working basically full-time on these issues. And so, you've already seen some of the products of that with respect to roundtables that we've hosted, some of the issues that we've mooted. And so we'll be bringing various types of solutions here to the fore, like I've been talking about an innovation exemption, and with a goal maybe of having like a super app where there are many different agencies that are concerned about crypto, but why should you have to go and register at multiple agencies if we all are focused on the same kind of goal, and why can't we have mutual recognition among them? So some of that will be solved in Congress, and others, I think, between the regulatory agencies will be able to solve that.
So obviously crypto is a major thematic priority, as is just more broadly on-chain finance. Tokenization of real-world assets was something that I moderated a panel on just a couple minutes ago, and other panels have talked about market structure and the changes that tokenization of securities could bring to market structure. How are you looking at tokenization as a thesis? Where do you think the SEC is most likely going to lean in? And what would you like to see when you think about the development and really the intersection between the agency's policymaking and rulemaking and this particular development in our markets?
Well, I think tokenization is necessary. We have this technology, distributed ledger technology, which to me is the most exciting part about all of crypto. And it's not necessarily the coins and all of that. I mean, they will come and go. But the DLT aspect, putting things on chain, I think presents huge potential benefits for financial services and elsewhere, for de-risking, the markets. If you have, we're now at T+1, we could get to T0, and we'll probably have to build in speed bumps to keep, the fat finger problem or something like that to happen. But to have immediate DVP, RVP, for transactions, I think is unbelievably great. And then the transparency that brings in, it solves a lot of compliance issues as well. And then it just makes it much more, I'd say, democratized and accessible for various products to be tokenized and to have people have access to that. So I think it would solve potential problems that we haven't even thought about, all the ways that it could morph in over time.
So I kind of jumped the gun, excuse the pun, for a securities lawyer and law prof, in terms of one of the questions, in the sense of, okay, tokenized securities, embedded in that word is the word securities. I can't help but ask it, especially since we're still waiting on different market structure legislation, and certainly Hester Burris and Mark have actually been very involved in this program in DC Fintech Week in previous years. But Howey test, is this still a standard? Is this still a rule that, or a framework for establishing the regulatory perimeter? What do you think are the strengths, weaknesses, future of the Howey test?
Well, I think that's been a bit of a red herring. I'll be, maybe off on one tangent on that one. But so if you think about the Howey test, that was back in 1946 or whenever the Supreme Court came with that, because there's this term, investment contract, in the Securities Exchange Act of 1934 that the drafters didn't bother to define. So the court took a stab at it, and for 1946, with that particular set of facts before it, it came up with its four-part test and whatnot that most of you all probably know. If not, you can search for that on the internet and get an answer really quickly on that one if you don't know about it. So anyway, but that is the law of the land as far as what an investment contract is. But I think we have to be more particular when we try to look at its application to this new technology. So I would argue that the various coins almost always are not securities, and that you have to find the investment contract, you have to look at the entire ecosystem around that particular coin or customer offering or whatnot, to see that it's the promises that are being made by those folks who have developed it. And so that itself is the contract, not the orange, like in Howey, not the orange tree that was planted and has to be tended and watered and fertilized, but it's the actual promises around it. And I would compare the token to the orange that is what's traded.
And again, these are issues that have been debated a little bit ad nauseum, but given the fact that you are now in the chair seat, it's just interesting to sort of hear your thoughts. The term decentralization, especially when you move out of, let's call it institutional DeFi into DeFi, or institutional on-chain finance, to DeFi, decentralization still pops up as a conceptual policy consideration. Is that relevant? Is the concept of decentralization relevant to the SEC and to your understanding of either what is a security or just as a policy matter as to what's preferable or to be aspired to?
Well, I think, we'll see how the market develops, frankly. You can't expect what we confront today in 2025 will look like in 2029 or 2035. So I think we have to make sure that we approach this all in a very flexible aspect. And so, with respect to what the SEC looks at and the CFTC and the others, again, we all need to be working in sync and be harmonized across the board. And so that's what I really look forward to doing, and what we already are doing. We had a nice roundtable about a week or two ago for harmonization between the CFTC and the SEC. So the thing that I hope doesn't end up is kind of what we've had here on and off for the last 40, 50 years between the two agencies. You have two fortresses, and you have a no man's land in between, and that field is littered with the corpses of a bunch of new products, would-be new products that never made it because of the battle between, not at the commission level, but really at the staff level over the years. And so portfolio margining, which is something I think we can tackle and solve with the spirit that we now have between the two agencies, single stock futures and that sort of thing, some aspects of swaps. So I think that's only with the extant sort of product universe that we have now, so much less looking at the future where I think we can really make efficiencies stick and working together.
So, and also, by the way, just as a quick aside, I mean, the idea of thinking of it as a super app, thinking about the regulatory coordination as an app in and of itself is very clever and really gets at what's been a very long-standing challenge of how do you get different agencies with their own institutional sense of urgency to sort of coordinate on the same page has never been very easy here in Washington, shocker. But just to get back to that issue, you'd mentioned swaps, you'd mentioned some of these other products. When I talk to my friends in decentralized finance, there's a lot of energy in trying to figure out what institutional DeFi looks like. Like, how exactly do you get institutional actors to decentralized finance? And I do observe and I share with them the fact that sometimes even if certain liquidity pools are not regulated, the financial institutions often are, or they may be considering other kinds of operational risk issues. What at a 10,000-foot level would be required to get DeFi, TradFi ready? That's the only T-shirt now, people.
That's right. So, well, I don't know. I think this is going to be an evolution in the marketplace. So you have traditional financial institutions that are also now playing catch up to those who are, kind of native crypto types of, institutions or trading platforms or whatever. We do have laws that, kind of lean one way, but the good thing is that we at the SEC, with respect to our statutes, have pretty broad authority for exemptions to be made. And so I think we can be, very forward-leaning in that, and in order to accommodate new ideas, to whatever, to extent, but so we'll have to cross those bridges as we get there. But for now, our real project to focus on is to embed the idea of innovation around the agency to accommodate new products that as they come forward, and then police the markets to make sure that investors are protected and that they're not getting trampled upon by whatever may be out there.
So one of the, and I promised I was going to ask almost every regulator this question, starting early in the morning with the president of FATF who dropped by, to Travis Hill, to Governor Waller, and now for yourself. I've now been in Washington for a long time, and I've come to sort of feel sorry for the heads of agencies because it's a tough job. You get blamed when things go wrong, but you never are given credit when things go right. Always makes a little bit of surprise. You know this, and you yet once again embrace public service in this moment. But experimentation is not something that you normally associate with regulatory agencies. Innovation is not always, although I do tell people when you look paperwork crisis in the past, there have been moments in which the SEC has been sort of nudged to move. But on a personal matter and as a regulatory matter, how do you navigate policymaking and even embrace disruption and market forces as a regulator when disruption is ultimately disruptive?
Right. Well, the history of the SEC, frankly, except for the last few years, has been one that it might not be at the vanguard of leading the way towards innovation, but it's never really stood, athwart the the stream that's going forward. So, for example, back there was what's called the paperwork crisis back in the 60s, where you had paper certificates. If you've never seen one of those, they're really
I
cool.
tell my students about this all the time, and they're like, no, they were everywhere. Like papers were like on the floors and everything. It's a hugely important sort of moment.
Yeah, so you had clerks running from down in Wall Street, and other financial centers around the country, running with their carts of boxes stacked high with these paper stock certificates to go to the transfer agency, and then once they entered in, and then going to the other broker and to the new customer and whatnot. So there was a big bull market in the late 60s, and so the New York Stock Exchange had to close down at least one day a week, if not two, to catch up on the paperwork. So imagine that today. And so then the SEC worked with the industry and set up a co-op called the Depository Trust and Clearing Corporation, which still exists, and the whole idea of a global certificate. Then you had book entry securities, so that's one. I worked for Richard Breeden in the early 90s, and there was a new product that was the S&P 500, ETF, so spiders. That had been wafting around. I talked about project management earlier, wafting around the agency for something like 3 years or something. So one day Richard came in and threw on my desk this big file stack of papers and said, "Can you find out why this thing hasn't been approved yet?" So basically, it had gone bouncing around like a pinball over different divisions of the agency, and the agency heads asked Richard, "Well, how do we know that the market will accept this if we approve it?" And Richard said, "How do you think we're going to find out?" So that means let it out there, let the market decide. And the same with Arthur Levitt with Reg ATS to set up a bespoke a chance for non-exchanges to set up their alternative trading systems for institutions and whatnot. So those sorts of examples are where the SEC has stepped forward to basically help power changes. And sometimes, it gores somebody's ox. But in the S&P 500, spiders at first didn't take off, and then because the market was unsure about it, but then boom, after several months, it really did soar, and look where it is now. So those sorts of things you can never tell what it'll be, but again, we should be, as an agency, trying to facilitate these experiments. And so if we can come up with, what we're talking about with an innovation exception, to in a controlled way to allow people to test their ideas, in a controlled environment, and get a proof of concept, and then go public or whatever with that. So
when talking again, the paperwork crisis is a great example. earlier we had a great demo with AWS looking at sort of intelligent processing of documents, intelligent documents and documentation in and of itself. You obviously have blockchains that provide a lot of transparency, or new kind of transparency for financial services. And it opens up both the financial product vector, but also new kinds of ways of thinking about compliance and supervisory technology, even within agencies. Have you given very much thought to that, and how experimentation from that end would be either delivered from the private sector or from the SEC itself?
Well, I don't know. I think we should rely on the private sector to do, the experimentation and whatnot. I think I'd get a little bit skeptical for the government, basically, to do that. We're not really, I think, equipped to do it. But obviously, there's lots of ideas in the private sector, and I really, we shouldn't be stifling them unless they're true rip-off schemes and things like that. Obviously, we have to be attuned to that, and we have plenty of we have arsenal of weapons, I guess, that we can use for people who do that, and we're still using that in the crypto sphere as well if people are not are crossing the line.
So again, another shift, because your work is broad, deep, and you're really thinking about fundamental market structure issues. I'd heard you talking about making IPOs great again, which made me chuckle, because you're bringing attention to something I've written about and I told you about before, like from my earliest days, and I'm no longer a young professor, so it's been an issue that's been
You're
around.
an old fossil now.
I'm
right.
getting there, step by step. And like the decline of public markets relative to the rise of private markets has accelerated over time, right? And as we said, becoming a public company is no longer always that mark. It's no longer the gold star all the time. How do you think about that reform process? Like, how do you really reinvigorate those the IPOs and being a public company?
Yeah, well, first of all, we are so blessed in this country to have such robust private markets where people are willing to risk their capital to invest and promote good ideas and things like that. So, and lose their money, if it doesn't work out. So that risk appetite is something that Europe would love to have. I was on a trip over there, 4 cities in 5 days, one of those crazy trips. But every stop, London, Paris, Frankfurt, Brussels, everyone was talking about, we wish that we had an American investment ethic over here, and that that our citizenry would be accepting of risk and not risk averse, and not just putting things in the bank, but actually putting money to work in investments. So we're so blessed to have that. So as those markets have grown, that's taken the shine off the public markets. It used to be cool to be public. You've arrived. I've done my IPO, ringing the bell, and all of that. And so that's not so much anymore for a lot of reasons. One is litigation. 2 is just the weight of disclosure and the cost of going through the disclosure and hiring lawyers, accountants, and everything else. And then finally is the corporate governance scene of how there have been abuses and weaponization of basic things like shareholder proposals and all of that. So we're out to change that. We've already announced a difference of a change in philosophy at the SEC. We will let people go IPO if they have a bylaw that requires mandatory arbitration, and also with respect to fee shifting, loser pays, if they have that bylaw, they'll be accelerated just like anyone else. We're going to be working on lessening the regulatory burden, but making it smart regulation. We're not talking about throwing the rule book out, but there's so much information. Whenever I go to meet with portfolio managers or even normal investors, the first thing I hear is, please, 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 there's so much data, that information that is put out by public companies that we can't separate the wheat from the chaff. And that's what Thurgood Marshall, when he wrote a seminal opinion for the Supreme Court back in 1976, TSC Industries versus Northway, that's when he articulated the standard of materiality and saying it's what a reasonable investor, not a particular investor, not BlackRock, not Blackstone or whoever, but the objective, reasonable investor would need to know in order to make an investment decision. And he articulated the problem of the potential information overload if people just dump all sorts of information that's not easily digestible. So we have to pay attention to those basic building blocks of why we have disclosure, and that's helping people discern what the difference is between what's material and what's not.
Yeah, I mean, I had a conversation maybe a year or 2 ago with some of the folks over on people Dan Gallagher and others over at Robinhood, and to sort of think about like what does disclosure even mean in an age of gamifying or figuring out ways in which people can access information that's not as much of an overload and not as burdensome as for the issuers. I think it's a really interesting and important area. I did ask your predecessor a couple of questions on the accredited investor standard. You may not have liked all those questions, but I do think it's important. And but where do you see the future of the accredited investor standard? And is this at all sort of falling in your sort of vista of to-do items or priorities over the next couple of years?
Yeah, well, so that's a multifaceted question, I guess. So
I'm a law professor, that's what I do. It's like part A.
We could write an essay about this, but accredited investor is the for those who aren't into all this, it's the concept of substituting wealth or income for somebody's, and then discerning that that person has sophistication. If he has more than X amount in the bank or earns more than whatever, and then he can either know it himself to make the investment or can hire people. So that's a really blunt tool, and so there've been discussions over the years of well, why can't you have a driver's license? Why can't you have an investor's license? And things like that. So we're looking at all of those things, but in the meantime, we have an executive order from the president that is directed to us and to the Department of Labor to look at the ability of normal investors to be able to put a portion of their investments into private funds that in the past were only for accredited investors. So we will be coming out we'll be working hand in glove with our labor colleagues, and we'll be looking at those sorts of things and to allow access for that into 401ks and other ERISA products, and then to IRAs and whatnot. So I think that would be, if you look at the current state of the market, the S&P 500, you have the Magnificent Seven, and so the market is way tiered tilted towards that end. We have with respect to the rest of the S&P 500 or the public markets as a whole, it's we have half the number of public companies as we did 30 years ago, and so people are staying private. So to have a well-diversified portfolio, I think most portfolio managers and investment advisors would say you should have some exposure to the private markets. And so what that will mean, we will be working on that. But let's just say that we have to have guardrails around it. We can't just throw open the gates and have Wall Street dump some of their trash down that particular lane. But be looking at liquidity, valuation, where people would be standing in the capital stack of whatever they're investing in, looking at making sure that these investments are properly calibrated to the investment criteria of people. So people have been talking about lifestyle, target date funds, that sort of thing. So that's an idea, but still you have to have whatever goes in there the valuations have to be right. They have to come to they can't just linger on forever. You can't sell to somebody who's 86 years old something that will come to term in 25 years. So we have to, those sorts of things will be relying on the fiduciaries that are involved and all that. So I think it's an exciting time, and I think that will be good for the American people.
I mean, that is exciting. I love the idea of, in essence, looking at portfolio diversification as one element of investor protection, right? And I applaud that direction, and I'll be watching eagerly and with interest. I guess we're about out of time, so I did want to ask one question that's always very helpful. I mean, we've seen, and I think it's useful for this crowd, we are in Washington, D.C. We see changes, obviously, in policy every couple of years, and they can be very meaningful. How does a regulatory agency, how does a chair of the SEC sort of future-proof their work? How do you make sure that whatever you deliver on the policy end, it's just not something that reverts back and forth from one administration to the other? What's your thinking about that?
Yeah, well, that's a real tragedy. We shouldn't have a ping pong match, and I think that's a sign of a banana republic, frankly. So anyway, what we have to do, and I like the term future-proof, we need to, what we do, future-proof it. So by that means the acceptance by the marketplace and by investors. If we have undergirding from Congress on the statute side, and we'll see right now there's a market structure bill working its way through Congress, and so hopefully that will be on the president's desk by the end of the year, as he had asked, and then through other sorts of means, through the courts and whatnot. I think as we focus on the basics, on the standards of financial materiality, on openness, on access by the broad body public to the some of these products. I think that's the way we can do it. And then we have the Administrative Procedure Act. So if we have good, thoughtful rules that are backed up by economic analysis and by comparison, say, to what's done in the States or elsewhere around the world, I think all that helps to future-proof it so that it's not battle of personalities or left versus right or whatever. We're talking about investors, and I really don't think that these issues should be political ultimately. And so we're talking about how people invest and save for the future, for their families, for health, education, and all that.
Chairman Atkins, thank you so much for your time. With that, everyone, we are concluding day one of DC FinTech Week. Well, let's give it up.
Thank you.